How you doing? It's Nate Swaby here, Swaby Estates, and today I'm going to talk about commercial. I thought, we've been talking about residential. Let me switch it over to commercial, commercial, industrial, office space, and so forth. It's a little bit more complex. Obviously, there's a little bit more strategy required, a lot of research. There's a lot of things to consider, especially it's a little bit more in depth than a residential purchase. So since we're on that topic, let's focus more on retail. Now, obviously, there is office space, there is industrial space, most of which a lot of the parameters in terms of how you're valuing these properties are relatively the same. Cost per square foot basis. Of course, you can look at it from an equipment basis, you can look at it from an income basis. But most importantly is most of them is cost per square foot basis because the only way to make it relative to everything, because every individual business is different, is usually on a cost per square foot. How much square footage are you getting to use for your retail business or industrial business or whatnot? That matters because the more space you have, obviously, the less they can rent out to other people. So bottom line is, when it comes to retail space, now obviously you can go to high-end retail, you can go to low-end retail. Let's start with low-end, since low-end is mostly what most people would be focused on. Usually a retail business that can be food, restaurant, pet stores, home improvement store. Maybe you have a spa. Any of these are retail, small retail-based businesses. And things to know about these businesses, of course, how are you going to value these things? Okay, so maybe you're coming in, you're trying to buy a business. Let's start there. You want to purchase a business, and ideally, let's say you're trying to purchase the restaurant business. It's one of the more common businesses you'll find, especially in Ontario. So you're coming in, you're looking at a cost per square foot basis. Maybe you're going directly to the landlord, and it's a shell. There's nothing inside, and you're looking to purchase this space. Now, or when I say purchase, I mean that you're actually purchasing the business, but you're really just trying to lease the space because maybe you're not in a position in which you can afford to buy a space, which would be ideal, of course. But you're leasing a space. You're going to look at a cost per square foot basis. You're going to compare it with other cost per square foot in the area and what has rented, and that will give you a great idea in terms of what the space is worth in terms of what you'd be willing to pay on the high and low end. Obviously, most small retail is going to be anywhere from let's say 1,200 to 1,400 square feet, but we could say 1,000 to 1,400 square feet for retail to have enough space to do whatever you need to do, whether it's a kitchen or you have back space for storage, and then you're also trying to consider the fact that you might have people sit inside and eat. You want to have some space for that. So let's say small retail, you're looking at a lease. And are you salvaging the space? Maybe there was a previous tenant there that actually had the same type of equipment. That would be ideal, of course, as a tenant coming in, because now you save a whole bunch of costs. Maybe it already has a hood range and a grill and a deep fryer and whatever you need. This is one kind of way that you can go about it in terms of searching. Obviously, that's going to probably be a hot commodity around restaurant businesses. But again, you're basing on a cost per square foot basis. There's no business in there to derive any other value, of course, and usually you're going directly to a landlord. Now, the other ideas is you could have a shell, a brand new unit. This one's just built, and you have access to it, so now you want to put a business inside. Now, most people will go with a franchise, of course, because as you're starting out, it has a lot of key things, like it has resources, it's got a ton of knowledge, it's got great customer service and proven success. You have training, perhaps. All these things will matter because as you're coming in brand new, you might not have a great rounded mindset of how all works, and you're going to need the support, and that's fine. Usually people look at it as a stepping stone. It's where you start, right? So you're buying a shell. Now you got to negotiate a lease. Maybe they have, maybe the franchise has leasing agents that can assist you with this, or maybe they just have somebody that's familiar, like a lawyer that they have on team that they can do that with. You can always resource your professionals. Obviously, a real estate broker like myself could, obviously assist. I've got experience in the field, over 10 years of retail experience in terms of my own restaurants. You could do, you can go to your accountant, obviously, to get your income statements reviewed and make sure that, financially everything looks good. Like you're going to have them review it anyways, right? You're going to have them look at the franchise in terms of a whole, look at average store and what they make and see if the value makes sense. You're going to be doing a lot of research. You're going to be looking around and finding out what these other average stores produce and where they're located and how much density there is there. Density is a huge one. You have a lot of density, you have a lot of potential. If you have a lot of potential, well, then all you have to do is focus on marketing, great customer service, maybe you have a great product. All these things are going to matter, especially in your research. Is there transit? Do you have a GO train station, TTC? Maybe there's, a bus line or a highway. These all matter as well. What's your peak hours of day? When are you going to have most of your thing? Are you in a residential zone or are you in a commercial zone? All these things matter. A lot of this research can be done, obviously, or maybe provided from the franchisor, and this will help you make your decision better. And of course, when you're going in to negotiate the lease, some of the things you might want to consider, in the TMI, which is taxes, maintenance, and insurance, or CAM charge. These are like condo fees. You know what I mean? You pay into these things, and what they do is they maybe they provide security for the plaza, maybe they improve the plaza, they put pylon signs, they maintain the roads and stuff, surfaces, they salt and remove snow, garbage. These are all things that the landlord usually provides, especially if it's if you're talking about a commercial strip, multiple stores or restaurants. This will be usually pretty common. And then when you're negotiating the terms and terms and conditions in a lease. These leases are huge. They can be anywhere from 10 to 30 pages. All of them, of course, relatively in the favor of the landlord. You want to be able to negotiate and find out what you can negotiate. What terms are you negotiating? Maybe free water is included in the CAM or TMI. What's your term like? Are you having a 5-year plus 5? That's 10-year, or maybe you're asking for an additional 5-year option. If you're a bigger retail space, maybe you're McDonald's, you want maybe a 10 plus 10. These guys stay in there for longer periods of time. They have a larger investment that they're putting into the space. Is there anchor stores? These things are all factors you want to be considering. Also, you can negotiate terms like rent free. Maybe you're spending time, you got a shell store and you want to build it out, and that's going to take you 2 to 3 months. So you want to have some rent free period in order to actually do that. Without any cash flow, it's going to be hard to pay rent. So these are things that you want to be mindful of. Again, things that you would go to your professional for to find out how to go about this the best way. Now that's, of course, if you're coming in as a tenant. You can also ask for, additional, support. Like the landlord, you can negotiate. Most people don't know this, but you can actually negotiate for a tenant allowance, right? You're going to be leasehold improving this property. Well, guess what? The landlord benefits. One day you're going to leave. And when you do, they're going to leave a lot of those things behind. I mean, the walls are still painted. The flooring's still done. There's still, stove, hood range, maybe there's, sinks. All these things are improved, leasehold improvements that are going to stay behind, which you notice if you go through your lease, you'll find out that these things have to stay behind other than branding. Naturally, the landlord gets, to benefit from that. So, they're going to provide an allowance for you to actually do the build out, right? That helps you reduce your costs. So there's a lot of things to be mindful of again. Now, of course, that's from a tenant perspective. Now you're looking from a landlord perspective, this could be a great thing. I mean, one of the best scenarios, especially when you're opening a retail space, would be to purchase the space that you're in, put your business in it, and then now you benefit from two sides. You have two separate corporations. One, you're a tenant and you're actually paying rent, and you have a business that's cash flowing. And the other side, you're a landlord, and you actually get to, take in all the rent and actually make an income on that, improve your property with the CAM, TMI, and maybe you have other tenants there too. And then one day maybe you sell it, and then when you do sell it, well, guess what? You get to continue to be the landlord and continue to take in the money there while you sold the business and made some cash, so you can go do something else. So there's benefits on both sides. Now, landlord, of course, benefits the most. For the most part, because they benefit from asset appreciation, leasehold improvements, land appreciation. Maybe there's development in the area as well that's going to continue to expand. Maybe there's transit coming in. All these things matter, right? And maybe there's even space within the space of the land that you can actually put more retail in. You can add to it, highest and best value. So all these things matter, and all these things you want to be aware of. Now, obviously, economically, in this economic system that we're in right now, with higher interest rates, it can put a lot of landlords in a position in which maybe not only from this particular asset, but maybe they have other assets they have to, they have to reallocate some funds to other things, so they actually have to sell. And it's not because they have to sell that specific space, but maybe they're just trying to move around their investments, or declutter and reduce and take some cash off the table, de-risk a bit. So it bodes an opportunity for someone to come in and buy a space. Maybe the area has a high vacancy rate in which a lot of the tenants aren't actually in the spaces. They just can't find tenants, so they're paying too much out of their pocket. They want to offload this asset. So it's a great opportunity. And then as a tenant, of course, it could be opportunistic as well, because you got to think, as a business owner, you have a business, and unless you're an essential business owner, you sell essentials, like maybe you're a grocery store owner. Well, these are a little bit more resistant from recession, because obviously people need these things. These are necessities, versus maybe a restaurant. A restaurant might not need these things. I mean, these are things that people go and indulge in, their desires as opposed to needs. So thus, your business would usually take more of a reduction in terms of cash flow because there's less people buying. People are more focused right now on Christmas. They're focused on food, putting food on the table, paying their mortgage. So it's going to reduce business. Now, obviously, that bodes an opportunity, again, for the person coming in to buy. For the person trying to sell, it's going to be a little bit more of a tougher time. So economically, you got to look at these things too, because the opportunities arise from both sides. And of course, going forward, when interest rates reduce, guess what? People will go out again and start spending, and the businesses will increase, and the asset prices will rise. So these are things you want to be mindful of, especially when you're going into the commercial space. What are you looking for? Is it a business? Are you going to be leasing? Are you going to be buying? Do you want to be a landlord looking for these kind of spaces? Maybe you start getting into bigger things, but we'll go into that in another time. Right now, I just wanted to at least jog the mind, get the mind thinking about other types of investments, keeping in mind that there's always another investment. There's always something you can do. It's mostly based on strategy and what you're trying to accomplish. If it's cash flow, great, there's a way to do that. If it's going to accumulate assets, great, there's a way to do that. If financing becomes an issue, there's lots of different ideas. There's mortgage brokers that you can go to. There's people that can actually go out and find other alternative lending opportunities. So again, these are things to be mindful of. I just, again, wanted to open the mind up to different ideas and show you that there is ways to make money alternatively from the residential market. And again, I appreciate you guys watching. If you have any questions, feel free. You can always reach out. Give me some of your opinions if you think this is good, valuable. If you find value in these videos, I'd love to keep making more videos and at least expand the mind in terms of other types of asset classes you can, focus on. Again, appreciate you guys watching. I'll continue to try and make more videos. And again, keep an open mind.